Howdy, Jacob here. Today we're looking at Encore Wire Corporation in the electrical equipment industry with 4.1 billion market cap on 3.6 billion enterprise value. Been around since 1989. That's a little bit of time. Manufacture and sale of electrical building wires and cables. Okay, recently huge jumps the last 3 years. Historically, though, high single-digit return on invested capital, still not bad. We do see very little debt here, which is positive due to the fact that their enterprise value is so much less than market cap. And then when your return on equity is the same as your return on invested capital, that means that you have very little debt. Um, Dividend, been paying a very consistent dividend, haven't raised it or whatever. So that's just to give a tiny bit of money back to their shareholders. It's just 0.03%, so it's really nothing at this point. But gross margin up, operating margin up. Operating margin is greater than what it was even 4 years ago. So we're seeing crazy growth there. Their balance sheet shows 561 million cash on hand, 220 in all of their liabilities, no short-term, no long-term debt. Very safe from a balance sheet perspective. Cash flow statement shows a little bit of reinvestment back in themselves. We can see that their property, plant, and equipment has jumped up pretty substantially, and their cash from operations also has jumped up very substantially. So they're producing a lot more free cash than they were before. Their use of free cash flow recently, outside of reinvestment, is quite a bit of share repurchases. It looks like in the last 4 years, they've gone from 21 million shares outstanding to 17 million, which is amazing. That's buying back almost 20% of your shares in the 4 year period. So, all else equal, market cap should be is what a company is worth. And so, for them to be buying back 20% of shares, you just basically put 20% extra in your pocket. Obviously, markets fluctuate and stuff, but essentially, that's what happened. I think I'm ready to make some assumptions here. I don't know growth wise if I'm going to be putting anything that's too crazy in here. I want to say there was an acquisition between 1.2 and 2.5. The only thing is they don't show that on this balance sheet. So I definitely want to look into this business and see where they, if they acquired a company here and what it was, due to the fact that I did say initially their reinvestment rate went up, but it could have just been an acquisition, and that acquisition, the other company that they bought had, property and plant, higher capital expenditures or as much as they had. So that could be the case there. But I don't know if I'd be expecting much growth. Maybe 3%. I don't know. Historically, they haven't had the most fantastic rate of return. They are just buying back shares with all their free cash flow. So I'm comfortable with the 13p in price to free cash flow at the end of 7 years. Buying back shares. I mean, they've been buying back a lot. So 4 billion would be 40 million. And they've been buying back way more than that. Their free cash flow is as high as 300 million. I would be surprised if they bought back 200 million worth, which would be about 5%. So that's giving money right back to the shareholder. But again, it's their use of cash. So you want them to be buying back cheap shares. We'll be seeing shortly whether we think that, or whether I think that's the case or not. Let's do margins have jumped up pretty substantially. I might put them a little bit lower than what they were, but still pretty high. Let's probably try 12 and 10. We get to a price that needs to fall 43% to get a 50% return with these assumptions. I mean, let's see what 10% looks like. 5. Yeah, I mean, I could see how. I probably couldn't, but 43% drop before you get the return I'm looking for. Buying back shares at these prices don't make the most sense to me. I mean, the use of free cash flow could be reinvested at likely a greater return than what they're buying back these shares with. Even if they're paying a dividend, you're getting 8+% return on that, 8 to 10 likely. And so I think that use of cash is interesting. The rest of the business pretty interesting, but just not exactly at the price point that makes it seem very obvious to me. So hopefully enjoy the video and have a great rest of your day. Thank you.